Right, good afternoon, everyone. Welcome to this afternoon's webinar. We're delighted to be joined by Professor David Miles CBE, who is a Professor of Financial Economics at Imperial College. He was formerly a member of the Monetary Policy Committee at the Bank of England between 2009 and 2015, and before that, Chief UK Economist at Morgan Stanley. He's now a member of the Commission of the Central Bank of Ireland. So in terms of what's going to happen this afternoon, the webinar is going to run for sort of just over 50 minutes. David is going to run through a short presentation for about 10 to 15 minutes, which is very focused on housing and property prices. And then we'll run through some sort of Q&A, initially focused really on the sort of the property and housing element of it. And then after that, we'll move on to sort of the economy more broadly as well. So we've had lots and lots of questions submitted, so thank you very much for those. But please do feel free to submit questions as we go along in the Q&A slot, and then we'll do what we can to get through those. So anyway, I'll now pass over to David.
Thank you very much, John. I'm going to do something that always fills me with trepidation, which is try and share my screen. I'm sure we've all been on Zoom calls where somebody tries to do this. Everything goes horribly wrong. But let's see if I can get the right screen up here. And hopefully, what you may be now seeing is one of my slides. Does that look good, John?
Yeah, that looks perfect.
Okay, fine. So as John said, what I'm going to do, first of all, I'm not going to speak for very long. You'll be glad to hear, because I think there's real value in getting a bit of a discussion going and dealing with some of these issues and hearing from you folks out there. But I'm going to talk a little bit about, as the slide title suggests, how did we get where we are today? What's been the path over the last few decades? And I think it's a pretty remarkable story. You'll be familiar with much of it. And perhaps a more interesting question, where might we be going next? So let me just check that again, John. Just can I check quickly that does take us to the next slide?
Yes, it does.
Excellent. Okay. So here's a kind of snapshot of the last 40, 50 years or so in the UK. The chart on the top left there, the bold dark line, is average house prices in the UK adjusted for general consumer price inflation. So you could think of this as, in some sense, real house prices. So we've used the consumer price index to adjust prices in the past for what they would be in today's money, if you like. So if you go back, 50 years there, 1968, prices around 50-odd thousand in today's money, now about 250,000. So it's been a five-fold increase in price. So that's a five-fold increase relative to the price of the average things that UK consumers buy: food, clothes, cars. If you think about houses as the single most important thing you buy, probably the second most important thing you buy in cars. If you just showed a chart like that for cars, and you kind of adjusted for the quality of cars now relative to the 60s and 70s, the price of cars would have fallen very dramatically. Relative to that, instead of falling, house prices have gone up by 500%. And they've gone up relative to people's incomes as well. I'm sure we're all, that's no surprise to anybody on the call today. That chart on the right there is what's happened to house prices relative to measures of incomes, either household incomes, taking account of the fact that some people have two earners in the house, or relative to the average single wage or salary. And on both measures, there's been a pretty substantial increase. It's a slightly shorter period, difficult to get the data reliably back as far as for house prices, but in the shorter period since 1977, so more like 40-odd years, there's been basically a doubling in average house price in the UK relative to people's incomes. Rents haven't followed quite the same path. I don't need to tell you guys that. And so the rental yield in the UK, the average rent relative to the average house price, a crude estimate in the picture and the lower of the three pictures there, has been on a sort of downward trajectory for much of the last 20, 30 years. And that makes some people worry that maybe house prices have been driven to levels that are really unsustainable. Why? Because some people argue, well, you should think of the price of a house in some sense as being the present discounted value of the real value of the services that you get from owning the house, either living in it or buying it and renting it to somebody else. So we should imagine that house prices should be linked to the present discounted value of future rents, and yet house prices have risen far more strongly than have rents over recent decades. Some people worry, therefore, that we're in kind of a long-lasting bubble that may nonetheless get burst at some point in the near future. And some of the comments I'm going to make about the past are an attempt to try and understand why that might have happened, why house prices themselves have risen so much relative to the price of just about anything else in the UK, and why they have risen in recent decades substantially more than rents. And I'm going to argue that there's a single phenomena which we're all familiar with, which is the reduction in real inflation-adjusted interest rates, which is a huge factor in explaining all this. And as long as one believes that the level of real interest rates, that is inflation-adjusted interest rates, can stay at the very low levels it's reached today, one might believe that there isn't a bubble and that house prices, no particularly strong reason for thinking that house prices will collapse in the near future. Nonetheless, highly sensitive to even relatively small changes in interest rates. Let me just for a moment show how the UK is unusual amongst the largest economies in the world. These are the G7 countries. This is now an index of real house prices. That is house prices relative to the price of consumer goods in these different countries. The UK is the green line. We've gone up more than pretty much anybody else, certainly amongst the big economies in the world. So not only have house prices risen dramatically fast in the UK, we all knew that, they've risen faster than in any other, at least large, industrialized, rich economy in the world. I'm going to talk a little bit, very briefly, no more than a few minutes, about some work I've been doing with economists at the Bank of England. There's a working paper in my name and her name is Victoria Monroe, which you can get from a Bank of England website. If anybody's got an interest in the research I'm going to spend some time talking about, I've got a web page. It's easy to find at Imperial College. You'll find it on there as well. And what we found is that if you want to try and understand why have house prices gone up so much more than incomes, you might have thought that, well, on average, house prices should rise in line with incomes. Rents tend to rise in line with incomes, but house prices have risen so much faster. Why did that happen? The single biggest factor we find is the dramatic fall in real interest rates. I'm going to jump on a couple of slides just for a moment. And these rather multicolored, busy-looking slides are an attempt to measure what you might call the safe real interest rate in the UK, the inflation-adjusted interest rate you can get on a relatively safe asset. And in the UK, we can measure that really very accurately because we've had index-linked gilts, inflation-proof debt issued by the UK government for, well, since actually the early 1980s. So pretty much all of the period I've been showing you this enormous rise in house prices, we can measure real interest rates. So let's start with the picture on the left. That just says, excuse me, doesn't matter whether you look at 5-year interest rates, 10, 15, 20, the real interest rate as measured by the yield on index-linked bonds issued by the UK government has been on a downward trajectory for basically 37 odd years, almost 40 years now, from the early 1980s onwards. And the change is very dramatic. Back in the days when index-linked bonds started to be issued in the UK in the mid-1980s, the yields were not far from 4%, plus 4. Right now, on the 10-year UK government bond, the index-linked bond, the yield is about minus 2.5%. So you've had something like 600 basis points, slightly more than 6 full percentage points decline in real interest rates. The reason I think that's hugely significant is that not only did you see such an enormous decline, but I think there are strong reasons for thinking that it was completely unanticipated. And the chart on the right is one way of thinking about whether it was anticipated or not. Did people see right back 20, 30, 40 years ago that, well, interest rates in real terms are just going to keep coming down and down? I think the answer is they did not. The chart on the left, what it does is it shows, just focusing on the 10-year yield, it shows, first of all, the blue line is the actual 10-year yield, mid-1980s up to a year or so ago. It's even lower today, incidentally. And the purple line is the so-called implied futures rate. In other words, based on the 10-year yield and the 20-year yield and the 30-year yield, you can work out, bit of bond maths that I'm sure many of you are familiar with, you can work out what did the market think the 10-year yield would be in 10 years' time at each point in time. So if you look at 1986, the actual 10-year yield was about 4%. And the purple line was saying that's what people thought the 10-year yield would be in 10 years' time. So nobody thought at that point that the 10-year yield 10 years ahead would be dramatically lower than it was today. And that's consistently true right across the period. In other words, wherever the 10-year yield was at any point in time, if you ask people in the market, where do you think it's going to be 10 years in the future, they would say, well, I don't know for sure, but my best guess is about today's level. So this dramatic decline in interest rates over the last 35, 40 years, every time interest rates fell, in real terms, the market seems to think that, well, they'll stay at that new level. They won't fall any further, but neither will they go back up. And that's why they've had, I think, such an huge impact on the value of houses. It also, I think, explains the decline in rental yields, which has been actually pretty much in line with what has happened to the decline in real interest rates on government bonds. Forget about the yellow line for a minute. Let's just look at the blue line and the purple line. The purple line, again, is the real interest rate on 10-year government debt in the UK. The blue line is a measure of average rental yields in the UK. Both lines stop in about 2019. I think if you push them forward to today, they might even be both a bit lower. Certainly the 10-year will be more like minus 2.5%. Average rental yield in the UK varies a lot across the UK, as we all know, but probably not far from 5%. So these lines have sort of moved down in lockstep. And that's what you would expect to happen in an efficient market, that the rate of return on investing in housing should match a safe interest rate plus a risk premium. And if the risk premium and some other costs like taxes, which in the paper we take into account, and you can see the boring details in that bit of research from the Bank of England that I worked on. But I think the big story here is that if there had been, as happened, such an enormous decline in the safe real interest rate, it's no great puzzle as to why rental yields should decline. But house prices, which you could think of as being linked to the capitalized future value of rents, when you capitalize them at an ever decreasing discount rate because the real rate has come down, house prices will keep going up in ways that may have been unanticipated. If people didn't expect the real interest rate to keep falling, but it did, every time it fell, then the rental yield would tend to move down. Rents themselves, however, the absolute level of rents tends to keep pretty much in line with average incomes. So this picture here, in a sense, it's the final bit of the story, shows rents, average rents paid in the UK as a percentage of average incomes, either household incomes or the average single salary. And that's a very boring line. It's pretty much flat. So the rents that you expect to get from housing move in line with incomes, but you discount them at a declining required rate of real interest on assets tends to be on average declining, didn't decline every year, but on average it was falling. Hey presto, you generate enormous increases in house prices, which people hadn't anticipated at the beginning. For what it's worth, and I'm not going to go through these numbers in any great detail, but if we just look at just the top line, literally the top line, the top row of these numbers, here the period 85 to 2018, a period over which real house prices are up by 160 odd percent, we reckon that the lion's share of that, about 100 percentage points, i.e. a doubling in real house prices, could be put down to a knock-on effect of a reduction in the general level of real interest rates in the UK. So let me just say a few things very briefly about where we might go next. So the first point is that because house prices are likely to be highly sensitive to the level of real interest rates, and I'm talking again, just to stress you, about inflation adjusted interest rates, real interest rates, because we're trying to explain the real house price, to explain that in terms of real interest rates. As long as one believed the market, which continues today to assume that the very low level of real interest rates will persist for some time in the UK, if one believed that, then there are quite strong reasons for thinking that we're not in a bubble at all, that this big increase in real house prices over the last 30, 40 years is a sustainable phenomenon. Of course, if that's true, and we all understand this point, no great mystery here, what it means is that housing is very expensive for young people. You have to borrow a very large amount relative to their incomes to get into the housing market. Mainly that will mean people have to postpone the rate, the age at which they buy houses relative to the age at which many of us on the call today may have bought a house. 20, 30 years ago, not unusual. People in their 20s, now it's more like mid-30s. That will mean that the government faces various choices. It could try to offset the impact of very low interest rates by massively expanding the supply of housing in the UK, which would indeed, if it was successful, bring house prices down. But the scale on which you would need to do that, I will argue, is unlike the plausible scale on which you could do that is unlikely to have a very dramatic impact. So in the UK, we build, over the last 10, 15 years, we've struggled to build much more than 200,000 houses a year. Suppose the government from now on forward for the next 10 years could build 300,000, 350,000 instead of 200 odd thousand. So suppose it could build 100,000 more a year for 10 years, that's 1 million new houses. But relative to the stock of houses in the UK, it's 25 million almost houses in the UK. That would increase the stock by 1 over 25, 1 million new houses. That would only be 4%. So the stock of housing in the UK, even after a sustained period, a decade of dramatically higher house building, would be 4% higher. Back of the envelope calculation says that that might knock 5 or 6% off the level of house prices. Bear in mind that over the last 40, 50 years, house prices in the UK have gone up 500%. That scale of increases in house prices could reduce house prices by 5%, maybe if you're optimistic, 10. 500 offset by 10% decline. The numbers just make the idea that you could take house prices back to the level of affordability they were 20, 30 years ago by building more houses seem utterly infeasible. I think, though, there's one factor that might have a significantly bigger impact than trying to, in a sense, build your way back to the affordability of the past. This is a kind of speculative thing that let me just mention in conclusion. And it's the prospect that, and we're all familiar with the idea, that more people will sustainably, permanently work from home much more of the time in the future. I think we've all been hugely surprised by, for many of us, how relatively easy the companies we work for have found it to maintain production, even with a very large proportion of the workforce working from home. And that's, I think, has worked better than anybody would have thought possible. If you'd said to people 18 months ago, what would happen in the UK if the majority of people could not go to their place of work, I think the answer would be economic catastrophe on a huge scale. The level of GDP might fall 40%, 50%. Though it's been bad enough, but that didn't happen. And I suspect that many more people will at least have the option of working from home maybe 1 or 2 days a week, which wasn't there 18 months or so ago. What's that got to do with the housing market? Well, it may mean, of course, that living in places which are relatively cheap, living in places where it may be easier to build more houses and keep house prices down, even if your job is in a very expensive place near a main centre of London or Oxford or Cambridge, or expensive places to live in the UK. Maybe your job stays there, but actually you can work from home half the time, and therefore the commuting cost to you in terms of time, in terms of money, which might be unsustainable if you had to be in the office or your place of work every day, becomes much more feasible if you only have to be in the place of work, 2.5 days a week. And that allows people to live in much more affordable parts of the UK. In some sense, it's a bit like increasing the effective supply of housing in the UK. And since there, as we all know, enormous differences in the cost of housing in different bits of the UK, that actually may be the ability for more people to work from home a much more significant factor in making houses somewhat more affordable than the idea that we can just build lots more houses around the places where house prices are currently extremely high. One final point. I think one thing the government has done, which I think has been a really backward move and a very bad housing strategy, which was a couple of years ago, and you'll know the story better than I, the decision of the government to effectively increase the cost of offering buy-to-let properties, at least for people who weren't incorporated, the small buy-to-let landlords, through a combination of stamp duty and reducing the deductibility of interest payments on mortgages to buy buy-to-let properties. In a world in which it is likely that people will be in the rented sector longer, to try and reduce the supply of rental property in the mistaken idea that that will make home ownership more feasible for lots of young people seemed to me a catastrophically stupid strategy. And it's one that a government adopted a few years ago. Who knows? Maybe they'll change it. I've done my best to talk to people in government, and we'll see what happens. I'm not holding my breath on that. Let me stop at that point. Very happy to take questions and to listen to people's comments.
Thanks a lot for that, David. That's sort of a fascinating sort of walk through why house prices have gone up. And one thing I'd ask is, why the UK is different, because obviously interest rates have been falling around the world, and obviously some countries, obviously in much of Europe, they've been negative for longer than we have. Japan obviously has had long-term very low interest rates, but particularly Japan there, hasn't really seen any house price growth in the last sort of 30 years. And the same is true for a number of those other countries there, like Italy. Obviously, Canada has increased, and obviously countries like Ireland and Australia at certain times have had very high levels of house price growth historically. But the interest rate bit is, generally speaking, has been common around the world, or certainly around sort of G7 nations. But house prices have differed hugely.
Yeah, I think there's two big factors there as to why house prices have gone up so much more in the UK than most of these other countries. I mean, you're right that when you say that interest rates are low everywhere and have fallen quite a lot everywhere, in real terms, that is the interest rate adjusted for inflation. I think the decline in the UK has been unusually big, at least if you look over the kind of 30, 40-year horizons I've been looking at. The US has got a market in inflation-proof debt, so has Germany, so has France. So you can compare pretty much directly the yield on inflation-proof UK government bonds and the yield on inflation-proof debt from those other countries. And the UK has fallen by something like 600 basis points, mid-80s to today. In those other countries, it's been rather significantly less than that. Still a big fall, but more like 400 basis points rather than 600. So we've just seen an unusually big fall in real interest rates in the UK. I think a bigger factor does come back to the supply side. The sensitivity of new house building to increases in demand for housing is low in the UK. Most studies have found that the response of the supply of new house building, I should say, to increases in house prices in the UK is lower than in almost all these other countries. So we did an experiment in the research paper I've been talking a little bit about as to what would the UK have looked like if the UK real interest rate had fallen by as much as the average of these other G7 countries, and the UK had the sensitivity of new house building on average of these other countries. And instead of house prices going up as much as they did, they would have increased by about 70, 80% less over the last, I think we did the calculation, the last 30 odd years. So it's worth quite a lot, and it seemed to explain most of the difference between the UK and these other places. Japan is, as you rightly point out, Japan has had no increase in real house prices for the best part of 40 years. It may be, but I'm no expert on Japan. But firstly, they really did have an astronomical bubble. In the housing market, and it bursts relatively early in the period in the chart that you can see on the screen. And I think it really has had a big impact. I've got a sense, but as I say, I'm no expert on Japan, that because of that episode and what it did to the banking sector and the number of bad loans and people who got into all kinds of mess when that bubble burst in the early 80s, was that mortgage regulation in Japan, I think, is pretty tough, and people don't borrow on the scale that they have been able to borrow in the UK. But I think one of the big factors in the UK does come back to the supply side. And in fact, it's not terribly surprising. People talk about, the governments go on about the UK, we don't build enough houses. There are reasons, of course, why we don't. One is we are a very, very densely populated country. England is one of the most densely populated countries in Europe. We're up there with, probably not quite as densely populated as the Netherlands, but there aren't many other countries in Europe that are as densely populated as England. And the more densely populated you are, the more difficult it is to build more and more housing. So that's a kind of fundamental fact. Rather than being seen as a failure of policy in the UK, I think to a significant extent, it is a reflection of the reality of the geography and the density of the population of the UK.
Yeah, that makes sense. And on this, as you rightly said, obviously within the UK, there's huge difference in house prices, but also growth. And obviously, certainly up until recently, a lot of that growth has been, London has sort of led the way, not in a good way, if that I mean, but in terms of the fastest house growth. And people have sort of commented or speculation as to why that's been. And obviously, a lot of people have pointed towards London as being very attracted to overseas investment that may have driven it, through for a lot of that. Obviously, the growth of the financial sector as well. obviously, more recently, that hasn't been the case, and probably in the last 3 or 4 years, London has underperformed. And again, whether that's because of the increases in stamp duty, which obviously affect higher value properties, or Brexit means the overseas investment element dried up, and obviously more recently COVID, where, like you say, that people's housing decisions may change. And how do you see that changing? Does it slightly depend on the COVID recovery? Because there's been massive difference between, say, the northeast of England and London, and, like you say, and other parts of the UK as well.
Yeah. I think the aftermath of COVID is going to be interesting in this context. Particularly if, as I sort of speculated, more and more people will be able to work from home, which I think changes then in an obvious way the decision about where do you need to live to get that job, which maybe remains in the centre of London, or at least that's where the office is, or your place of work's there. That doesn't change. But if you only need to be in there 2 days a week, suddenly living, the other side of Oxford, where things begin to get a bit cheaper, which may be just infeasible if you have to go in every day, but becomes feasible if you have to be in there 2 days a week, and maybe you can find somewhere to stay overnight one night in London. I think that has the potential to really change relative prices, quite a lot. I'm sure we've seen it already, and there'll be lots of people who know a lot more about this than I, about what's happened to rents, outside of London relative to the centre of London in the period since COVID hit us all. And I guess the story is very, very different, central London versus, 60 miles and more away from central London. And that may turn out to be a sort of what you might call a semi-permanent adjustment, if there's a semi-permanent adjustment in people's ability to be in the office just an awful lot less. Obviously, it's very specific to what kind of job you do, and it's not going to work if you work in a pub or you're a doctor or a nurse, but it can work if you, work in an office. So I think that may be a quite substantial factor. There's some research already in the US about estimates of how many people in the US will be able to work from home. And I think I've got the statistic roughly right, which is that before COVID, something like, as I recall, 10% of people were able to work from home at least 1 day a week in the US, 10%. And the estimate is that will become 35 to 40%. I can't think of an obvious reason why the UK should be different. Actually, the structure of our economy is not that different. US got a small manufacturing sector. There's not that many people who have to pitch up at the factory. It's like us, big service sector. Manufacturing is almost a thing of the past. It's only 10% of GDP. So the UK looks a bit like the US, and they've been using the same technology. I mean, Zoom is universal. So if that estimate for the US is plausible, I can't imagine it's a bad estimate for the UK. That's an awful lot of people don't need to live quite as close to where they work as they did 18 months ago.
And this link between, obviously, this very important link between interest rates and house prices. There's two ways that I suppose it can feed through. One is obviously cheaper mortgages mean that people can borrow more and they can service more debt, and that drives up demand effectively and for properties. And then, like you say, the other side is looking at it as property as an investment, and it's coming through in the yields. Do you think there's a bit of both in the answer, or do you think one is more important than the other?
I think it's absolutely both. I think those people who are trying to buy first time, for them the overwhelming factor is how much you have to pay on the mortgage. And in real terms, those numbers are pretty low now, certainly lower than they were most points in the past. So that's a big factor for the new buyer. For the person who's moving for the second, third, fourth time, a bit later on in life, maybe the mortgage is now quite low relative to the value of the house. But that means you're just putting a lot of your own money that you could otherwise be investing in, the stock market or buy government bonds or whatever. Well, as the yields on those things have come down, the effective opportunity cost of tying lots and lots of your wealth up in the house that you're about to buy, the return you need to see in some sense from that enormous investment in housing has come down. So it's a similar factor at play there for the person buying a mortgage. And of course, for the buy to let, well, as the real rates of return on at least safe assets, UK index-linked government bonds are about as safe as an asset as you could get. As those have come down, then the acceptable yield on buying a property and renting it out has come down. We've all seen what's happened to rental yields. They've been falling for much of the last 20 odd years. And, it's not that the rents have fallen, it's the adjustment has come through house prices going up. So those mechanisms are exactly what's at play.
And you touched on, and there's been quite a lot of questions about sort of government intervention and stamp duty, and obviously you talked about obviously the changes that were brought into the buy-to-let market in 2016, but obviously there's been other changes that evolved around tightening of underwriting standards, and obviously post credit crisis in the owner-occupied market. We had the mortgage market review, which obviously made the sort of lending that happened pre-2008 virtually impossible, even if people did want to do it. And in addition to that, the government is constantly coming up with schemes for first-time buyers. And so there is this sort of view in government probably that it's buy-to-let landlords versus first-time buyers who are, squabbling over the houses. And there's all these different things happening, some driven by the government, some by the Bank of England, some by the FCA. First of all, I mean, are they actually achieving anything? Are they sort of helping first-time buyers? Are they changing the sort of mix between owner-occupied and buy-to-let? And likewise, are they just sort of really more political than actually making a material difference?
Well, I think they are political in a sense. I mean, I think we all remember when those changes in the taxation of buy-to-let properties came in. I think it was George Osborne was the Chancellor. And the big noise that was made politically about why the government was doing it was all about, we're going to make housing more affordable for young people. These kind of evil buy-to-let landlords, these rich individuals who've got 5, 6, 7 properties, they're gobbling up the housing stock, they're driving up prices for young people. That's why people can't afford to buy. We're going to do something about that. I mean, that was the rhetoric at that time. I'm not sure that some of the economists who think about housing in government, civil servants, believed all that, but that was how it was pushed. As I said earlier, I think that's largely mistaken, and it's not obvious at all. It helps people who are trying to get into the housing market, because for the period that they're not in the housing market, and that's longer than it used to be, they do need to be in the rental sector. If you squeeze the rental sector, it's not so obvious that the beneficiaries of that are the people who inevitably are going to have to spend some period in the rental market, because it just reduces the supply for them. Also, I just think my own personal view is that it's a misguided strategy, because it seems to play to the idea that owner occupation is intrinsically good, and it's a sign of failure in the UK that the owner occupation rate has fallen from, it was 70% a couple of decades ago. It's probably, mid 60s, maybe probably a bit lower than that now. That's a sign of failure. It seems to me that the right strategy when it comes to housing is to be neutral as regards the tax system, neutral as regards renting versus owner occupation. And these changes were clearly a step an even bigger step away from neutrality in the tax system. And I've always felt that it's a misguided notion that government should try to keep the owner occupation rate as high as it could. After all, there's plenty of countries in the world. Germany is the best example, probably. Not exactly a failed state. Germany, with a very low, relatively, rate of owner occupation and a very large rental sector, and it doesn't seem to have held the German economy back or caused, massive dysfunction in the housing market in Germany. So I do feel that this was a mistaken strategy. Are we stuck with it now? I suspect for a while. I think just politically, even if the government did come to view this change as on economic grounds mistaken, and I'm not sure they do, but even if they did, I think, it's not, let's put it like this, it's not going to be high on the policy agenda to reverse those decisions. Although I think they were mistaken. Of course, there is one way, if I may just say very briefly, there is one way of making housing more affordable in a way that I think is more economically justifiable. And it's this: owner-occupied housing in the UK is not well taxed for a whole bunch of reasons. Firstly, we do rely on stamp duty. That's a terrible tax. Most economists would say stamp duty is a terrible tax. There's a tax on transactions. You don't want to tax transactions in the market. You want fluidity and people to be able to move around. This is a transactions tax. That's not a good tax. A better tax would be a tax you pay, year in, year out as a result of owning a property of a particular size and quality. So the tax should be linked to the value of the property, not stamp duty, because tax transactions. And as we all know, the tax we've got at the moment is pretty regressive, in that the amount of tax you'll pay as a proportion of the value of the property declines really quite sharply when you start looking at really very valuable properties. So that the tax which on economic grounds is a sensible one is linked to the value of property, and that's the tax change that we probably need in the UK. Governments consistently have avoided doing that for the very obvious reason it generates, a large number of people who may gain a small amount and a small number of people who will lose a lot. If you made the tax just a fixed proportion of the value of your property. And because the losers will notice it and make a big noise and are on the whole the kind of people who are quite influential, I think it's very difficult electorally for a government to do it. So they won't.
And back in 2004, you produced a report for, I think it was then Gordon Brown, and he's Chancellor, if I remember rightly, if I get my years right, on the sort of long-term fixed mortgages. And obviously they sort of disappeared for a while, not disappeared, but there wasn't really much talk about them in the last 10 years. And obviously they've come back now, and I know that obviously the current government has talked about them, and obviously various government changes have meant that there's probably more 5-year fixes now than there were 3 or 4 years ago compared to 2 years. So we've moved a little bit towards longer term. What's your thought now? Because I mean, there hasn't really been a market for 10 years, whether it be from a demand point of view or from a supply point of view in the UK. But obviously, in most other countries, well, not most, but a lot of other countries, whether it be 10-year or 25-year, they're either the norm or a very popular product.
Yeah. I think the idea that the UK should sort of move toward a US style mortgage market, 25-year fixes being the most common product. I mean, I never thought that was a particularly desirable thing. And the report that I wrote all those years ago said that we shouldn't for one moment think that we should try and push the UK in this direction. I think there's a couple of things that have changed. I think we all know what they are, which has meant that there are now more kind of short to medium fixes, up to 5 years, maybe even a bit beyond 5 years. I mean, the 5-year thing is partly, I think, a reaction to the mortgage market review. The thing about affordability and stress tests on mortgages, that you don't have to test if the initial fix is more than 5 years. So, that's probably been a factor there. I think there's another factor, and it was a thing, actually, it was the main thing I talked about in that report, way back when, 2004, and the thing I highlighted there, and I think we all knew it, was there was a lot of cross subsidization in the UK market then. You had, the new buyers were induced into the market with teaser rates. You could get mortgages that were 100 basis points under bank rate back in the day, and yet people who'd been paying their mortgage on time for like 15 years and had a small mortgage balance were quietly pushed onto the standard variable rate. So they were paying, they'd be paying, 7.5% on their mortgage, and the new buyer would be paying like 3.5% on their mortgage. So that cross subsidy, which was hard to justify on any grounds of fairness or risk pricing, was pretty rife at that time. I think there's an awful lot less of that now. And what you see now is something you didn't see in 2004, which was a real differentiation. It's been there for a while now in the UK, a huge differentiation between the rate you pay if you want to borrow 95% or 90% and the rate you pay if you have to borrow 70% or less. And that didn't exist back then either. And those were the kind of things that I sort of drew more attention to than anything else. So, on the fixed rate mortgage thing, I can see an advantage to people now. I think fixed rates are remarkably low. And, maybe we'll stay like this, maybe we won't. But on risk grounds, but it's up to people to make their own decision on these things. On risk grounds, if I was looking for a mortgage right now, which I'm not, but if I was, I'd kind of look quite seriously at, 10-year fixes and things like that, just because I think the risks are asymmetric. In other words, bank rate ain't going to go any lower. We're not going to go to negative interest rates in the UK. I just don't believe it. So, they can't go down, and the scope for them to go up is quite significant. The yield curve in the UK prices in an expectation that bank rate hardly goes anywhere for the next couple of years, and then at a glacial pace, it gets back to 1%, 1.5%, and maybe that's on average what might happen. But what are the chances that it's more than that? Quite high. What are the chances that the Bank of England bank rate doesn't even increase by that much? I think they're less, those chances, than that we're on the other side of it all. So on risk grounds, this is just a personal view. If I were looking for a mortgage, I think I'd look more seriously at 10-year fixes than I might have at any other time. But that's for individuals to make their own choice on those things.
And that outlook for sort of interest rates, I think, I and probably most people for most of the last 6 or 7 years, we've sort of had the expectation that interest rates will go up in about a year's time to 1.5%, 2%. There's some belief that they're going to revert, and obviously that hasn't happened. They just kept on getting lower and lower, and obviously there's been a few things there like COVID and Brexit that probably people didn't expect. But even so, that's strange. Do you think this sort of low interest rate is structural, and we're going to be, demographics, or your colleague at Imperial, John Haskell, has written a book, Capitalism Without Capital, and therefore the supply and demand of money? Because if they do go back up, based on what you said at the beginning, then that could be a major driver of actually house prices falling. And at the same time, obviously, government debt where it is, if they do go back, government debt is not sustainable at the current levels if interest rates start to tick up materially. And so that therefore makes probably inflation as the biggest threat to the economy right now.
I think there's something in that. And as I say, I think the risks are very asymmetric. I don't think bank rate's going to get any lower. And I strongly sense a view in the Bank of England from most people that we just don't want to go to a world of negative rates. So, it's kind of one-way traffic, really. And is there a chance we get back to, 3 or 4 or 5% bank rate in the next 3 or 4 years? Yeah, there must be a chance. I mean, in a sense, that would be a return to normality. I mean, if you took, here's a boring fact. If you look at the period since the Bank of England was established in 1694, and then ask the question, what's the average bank rate over that, 300 and, almost 330 years? The answer is 5%. Before the financial crisis, conventional wisdom was, yeah, bank rate 5%. That's kind of on average where you expect it to be. So we are so far south of that at essentially zero, that I think there must be, a chance that the outcome is significantly higher rates than the market is pricing in. I mean, I'm not saying that that's, I think, the most likely outcome, but I think the risks are asymmetric. Put it like that. Will it come from inflation? Is that what would drive all this? Actually, I'm less worried. I'm less worried by many on that front. I mean, I know you hear the story just recently in the press, coming from some people in the Bank of England. Oh, look, the recovery is super strong. Unemployment's not going to go up. We're going to see, a boom over the next year or so. That might drive inflation back up. I'm a bit skeptical about that. I have a sense that there are many companies, particularly small and medium-sized companies, who are deeply damaged at the moment. I mean, they've racked up debt. They've been allowed to, have payment holidays on that debt. They've been allowed to postpone paying taxes. Maybe their creditors have been a bit generous in paying bills. I think there's a lot of companies that, as those support measures are scaled back, will be in a desperately difficult situation. And we're not seeing it yet. They're not becoming insolvent. They're not laying people off. Why would you? We're still getting lots of support from the government on the furlough scheme. I don't think we'll really know what the damage, in a sense, done by COVID is to the economy until all those support measures, and there are many of them, that get scaled back. And they will be scaled back at some point, and may not be till next year. But when it does happen, I think there's going to be a lot of companies that will really struggle. And the one thing I just do not think will happen in the UK is the thing that's always been behind the big inflationary episodes in the past, in the 1970s, in the early 1980s, at the end of the 1980s. And it is that we get a boom, we get a pickup in inflation, and it's driven and fueled by high wage settlements. And I just think there's going to be enough nervousness about most people, among many people anyway, about, is their job really going to be there? I think there's going to be enough nervousness about that to mean that wage inflation will not pick up in the UK. So even if we see this year GDP grows by 7%, 8%, and people will go on about, oh, this is the fastest rate of growth we've seen in the UK since the Boer War, that's a bounce back, right? That just takes you back to flat GDP as it would have been if we hadn't had COVID. That doesn't say we're in a sustainable boom in the UK. And I think there's going to be an awful lot of nervous people about their jobs, which means you don't get the wage inflation. And without that, you don't get sustained inflation in the UK.
Yeah. And on that, obviously, we had very positive signs on the UK economy earlier this week. Obviously, the US inflation numbers yesterday. And certainly, if you remember back to Q4 last year, people were expecting unemployment to double, and obviously now a large reason why it hasn't is the furlough scheme. But suddenly the recovery certainly is looking brighter than it did. And again, a lot of that, like you say, is down to the government schemes that have sort of come about. But how do you think now about unemployment, or is it largely down to what the government does on furlough?
I think some people have got a bit blasé about unemployment, I think, and a bit too confident now that with the economy picking up, obviously the surveys coming out of the business sector look much more confident. That's not really a surprise. And we haven't seen unemployment pick up. I think people are jumping to the conclusion, well, it's not going to happen. And I as I said a minute ago, it's just too soon to feel confident about that. There was a survey, I don't wish to sound like Eeyore the donkey, but there was an interesting bit of work done by a couple of people at the London School of Economics recently who undertook a very big survey of small and medium-sized companies in the UK. And basically they asked them the question, how close to really struggling to reopen? How close to insolvency are you? Are you kind of not close, pretty close? And I think there was something like 900,000 companies who were at the pretty close to wondering whether we can actually survive end of the spectrum. 900,000. Now, they were nearly all small and medium-sized companies, and on average they employed 4 or 5 people. But still, 5 people, 900,000 companies, that's 4.5 million people working for companies that are saying now, we're really not sure we'll be able to carry on. And that's not showing up in unemployment at all at the moment. And I hope it doesn't show up, but I think there's a chance it might.
Yeah, makes sense. And so I'm conscious now it's approaching 3 o'clock. So I'm just going to sort of ask sort of final question. I'm going to sort of put you on the spot a little bit. And obviously in your presentation, one of the things you sort of illustrated is that we've been very bad at forecasting where gilt rates are going to go, if that makes sense. So people have always just assumed that the 10-year gilt rate, they stay as they are. But that aside, in terms of how you sort of see the next 18 months panning out on house prices and interest rates and inflation and recovery, and I know it's a hard question to ask, but there's so many what ifs, etc. But what would be your sort of middle, most likely outcome, do you think?
Yeah, forecasting is a kind of, in some ways, a bit of a mug's game, but it's kind of, it's a perfectly good question, and people are interested in what might happen. This is a feeble answer, but it's kind of what I believe. I mean, I think there is an unusual amount of uncertainty, and that's a terrible cliche as an answer. People always say, "Oh, it's very uncertain at the moment," but actually, I think it is an unusual amount of uncertainty. And part of the reason is what we were just talking about. I think it is far from clear just how much lasting damage has been done to the UK economy by the lockdowns the last almost 18 months now, or 15 months, and that could play out in different ways. I think it is pretty unlikely that the Bank of England will be increasing interest rates over the near term. If you define the near term as the next 18 months, 2 years, I'm not really worried that we're going to get rampant inflation, growth's going to pick up, and the Bank of England puts interest rates up to 4% or even 3% over the next couple of years. So that to me, that seems a very unlikely outcome. There could be a sell-off in the bond market. That's a different story. The Bank of England, the Bank of England has complete control over short-term nominal interest rates. They don't have much control over medium-term real interest rates, things like the 10-year index-linked bond yield. And that seems more likely to go up a bit than go down a bit, starting from this extraordinary level. I mean, the 10-year index-linked bond yield is minus 2.5%. So that's saying that people are willing to lend to the UK government at an inflation-adjusted interest rate such that they lose 2.5% every year. So for a 10-year loan to the UK government, they're saying, well, give me back about 70% with compounding, give me back about 70% of my money in real terms, and I'm happy to lend you vast amounts of money at that rate.
It's good for the taxpayer, I guess.
it's very good for the taxpayer. Yeah, it's very good for the taxpayer. It's an extraordinary situation. Now, I'm not predicting that's going to, turn around hugely dramatically, suddenly, anytime soon. I mean, people have been saying that consistently for 25 years. I mean, 25 years ago, when the index-linked bond yield was like, 1.5%, 2%, given that it'd come from +4%, people were saying this can't last. That was when we were at +1.5%. So they were wrong then, and they've been wrong, including myself, for 25 years. So I've got a good track record on this.
Fantastic. Well, David, I thoroughly enjoyed the last hour. So thank you very much for joining us. And I'd like to thank all the people that have found the time to sort of dial in for the last hour and sort of talk about housing and interest rates and inflation. And I could have quite happily stayed here for another half an hour chatting about it all. It's absolutely fascinating. And like you say, the the future is phenomenally uncertain. I know that, and I totally agree with you. And you know, I agree that people always say that, but this time it feels even more true than it ever does.
Well, thank you very much. I've enjoyed chatting about this. And I can see there's some great questions come in. I'm just going through them now. So thank you very much.
Thanks a lot. Thank you, everyone.